welcome everyone. Thanks for joining Dealroom's podcast. My name is Orla, and today we're joined by its authors Tom and Sarah. Thanks for joining us. Do you want to, so it's 11 years since you've been doing this. Do you want to talk us through the journey a little bit so far?
Yeah, it's been obviously remarkable, the change that we've seen across the ecosystem over that time frame, which is something that we covered not in this year's report, but in last year's report. And what is, I think, fantastic is that actually this year, more than any other years I've worked on this report, it just feels very different. We feel like we've entered kind of a new era for European tech, and we really wanted to be part of that change and to use the report as a real voice for where we stand and where we need to go, and kind of highlighting what the path ahead looks like.
Well, I mean, I've heard you both talk about how this year there was a shift and how the report also became a bit more of a campaign rather than just a report. Why? What are the differences this time around?
So I think in year 10, it had felt like this doom and gloom had really set in Europe, that everything was negative. All you would see online and in discussion would be these negative memes. And so with the 10th anniversary report, we used that as a chance to basically say, hold on a minute, if you actually look objectively at progress over the last decade, we've got an enormous amount to feel proud of and to be shouting about, and so many reasons to be optimistic. And that was basically tail end of 24 and into early 2025. And then last year, for lots of different reasons, and actually Yoram you and I have spoken about this in other conversations, whether it's geopolitics, whether it was actually just everything that's happening in and around AI, there was, throughout the whole of the last 12 months, this just massive energy shift in terms of feeling like, we have most of the things that we need here, talent, great ideas, ambition. All we've got to do is kind of organize our resources and scale them up and reduce a bunch of complexity. And if we do that, we have, a great shot at being even more competitive on the global stage. And so when we went into planning for the report last year, we kind of felt like it was really important to not just have this kind of look back view, which we've been doing for quite a lot of time, but to just elevate the opportunities and look ahead and really kind of try and put out a shared vision for the things that we really need to work on and address as an ecosystem to basically go to the next level again. And I think a big mantra that we've had is what's got us here won't get us to the next stage, and you kind of always need to be progressing and looking forward in that way.
And you've also created these pillars in this edition. So this time you're really kind of directing people no, we also need to fix things. And do you want to talk us through those kind of 4 pillars then?
Yeah, I think what we wanted is a framework that's simple and that's action-oriented. And while we were compiling this Fix the Future framework, which is effectively those 4 core pillars, it became evident that there was a lot being done already across the ecosystem. So it was a great way for us to be able to bring this to life. So the 4 pillars are Fund the Future, which of course is a topic that we've been quite vocal about for a really long time, and we'll dive into it a bit more in detail as well. But we also had Fix the Friction, as Tom mentioned, really simplifying regulation, stopping kind of the fragmentation that we have across Europe, and just making it easier to kind of start and scale without leaving the continent. Empowering talent, so we've always also highlighted the kind of the breadth and depth of the talent base here in Europe, but again, really showing that there's more that can be done to make sure that we attract and that we retain the very best talent out there. And the last piece, actually, which I think is the hardest to quantify, but we've done our best here again, is embracing risk. And it's really this idea of treating risk as part of the core infrastructure of the ecosystem. Getting more risk-taking attitude across the board, so that we are actually championing working with startups in a way that is systematic, not on the fringe.
Nice. Very well summed up. But we also want to dive into this specifically. So you've chosen some charts for each topic. So should we start with fix the friction then? Do you want to talk us through the chart you've chosen here?
Yeah, I mean, I think the inspiration for this is, in some ways, all the success that European tech has had over the past 2 decades has happened in spite of the operating environment that we have and not because of it. All too often, as Sarah was just outlining, we consistently hear from founders, but also from investors that, whether it's employment, taxation, simply starting up and operating across borders, all of these things are slow, complex, and expensive. And that is, it's a dangerous combination when you are trying to operate and win, in a market that moves at a ruthless pace of execution. I think a lot of the things that we often talk about when we're in the room with policymakers when it comes to this is, startups ultimately think and execute in weeks and months, not years and or even quarters. And so the reality is that, let's say it's a licensing application for a novel product. If that is going to take you 2 or 3 years to realize, that can be a life or death situation. If being able to bring in this exceptional talent hire that you want to make to lead your revenue operations is going to take you multiple months, that's just going to completely stop you in your tracks. And so what we want to move towards is an environment that feels frictionless and where it's fast and simple to operate. And I think that the great news here again too is that this message has been really well received. Now, what are the things that ultimately, and if we kind of come back to the chart that we're showing, that we hear consistently come up time and time again, and ultimately become the push factors for why a lot of founders ultimately choose to go and relocate elsewhere, because they simply don't want to have to deal with the friction here. It is that it's still too hard and slow to get access to capital. It's hard to access customers at scale and unlock that, demand. And then, as you can see here, just regulatory environment, operating environment. These are, it matters for us to fix these things because not only are you going to improve the chances of our companies being successful and being the winners in their categories, but it's also going to be a thing that keeps more talent and more founders building and scaling from Europe and not choosing to go elsewhere where they see a better environment.
Although I have personally never been in the Bay Area, for example, but what you keep hearing is that a lot of things are just so much easier. You want to attract the kind of people that actually don't want to deal with admin because they're so obsessed with the product, so that the whole admin thing becomes like it's nothing. That's where you want to go to. And for a lot of European entrepreneurs, it ends up being a significant chunk of their job, basically, and that's what you don't want.
Interesting that the top things are still access to capital and customers rather than the sort of some of the admin related bets.
Yeah, I mean, I think that's why, Fund the Future and has been a topic that we've talked lots about, in particular when it comes to the growth stage funding gap.
Yeah, and so moving on to this chart, maybe on Fund the Future. So yeah, this is some Dealroom data and shows that if we compare Europe and US startups, for the same amount of capital raised, they reach unicorn status at the same rate. But obviously there are a lot more unicorns that have been produced in the US versus Europe, and so that comes down to access to capital. So you guys feel like this is a chart or point that still needs to be kind of hammered across then?
Yeah, I mean, I think this is first of all, it's a really great chart. I think it is actually a really good representation of, like for like, how is that progression towards, billion plus valuation. And I think what's really interesting is then if you pair that with, we have this other chart in the report that looks at the chances of raising a certain round size, you actually see that while, once you raise the capital, you're just as likely to reach effectively that milestone as a US company. Actually, your likelihood of raising a 15 million plus round is much lower in Europe. So it really talks to this funding gap, or this Series B value of debt that we refer to, whereby it is actually much harder for founders here to access the capital they need to scale. And that is increasingly becoming an issue because companies are, competing on the global scale almost from day one. So if you have a competitor on the other side of the pond that is raising twice as much capital as you, twice as fast, it creates a huge disadvantage. And that's one thing that is, coming back over and over again, which is that, that consistent funding gap. And I guess if I explain a little bit more what we mean by that, we basically look at two main areas where we're lacking capital. I think the first one is really from access to domestic European capital. So if you look at the share of capital that's contributed for round sizes of 250 million plus, you see that Europeans have a much smaller share than in other regions. So in other regions, 80% of the capital comes from domestically, regardless of the round size. In Europe, it's closer to 45%. So it's quite different just from on that basis alone. And so, of course, if you're a founder and you need to raise capital and you know that a lot of that capital is going to come from overseas, then you're more likely to go and fundraise in the US or in Asia.
And so all of these are related as well, because then you're more likely to relocate potentially if you've got those investors on your cap table.
Yeah, I mean, I think it's such a nuanced debate because, in reality, if you're the founder, why do you care really where your capital's coming from? You probably just care most about being able to get the firepower that you want, and then secondly that it comes, with sophistication, meaning you're getting a tier one investor behind you and all their know-how and experience and network. If you step back though and you think from a strategic perspective as for Europe as a whole and take a more macro view, the reason that it matters that we as a region become the source of funding for our companies is that that's what retains value within the ecosystem. So the returns are generated back to your everyday citizen walking down the street through their pension funds or whichever institutions are the ultimate source of capital. And with that too, it's exactly as you say. It's you're probably more likely to be successful than in grounding those companies from a headquarter perspective here in Europe. That means talent stays here, IP stays here. And the future spillover benefits of future companies and future angel investors and all those other good things are also more likely to be retained.
I think also what we see is that we want to keep the center of gravity closer to Europe, right? Because the more you're raising from investors abroad, your center of gravity starts to move abroad as well, right? And if your board is composed mostly of, let's say US investors, then you're much more likely to be influenced by that board. And effectively, over time, what we see is that we're going to struggle to effectively build Europe on our own terms, which is the tagline that we have for this year's report, because we won't have that center of gravity where decisions are taken, be closer to home.
Yeah, I think the other thing that gets confused in this sometimes is that I think is an important point to make, which is there's nothing here that is saying we don't want our best companies to go and succeed and win in the US. That absolutely, ultimately has to be part of the ambition. The reality today, at least, is still that for most, for many companies, it's going to be the biggest addressable market. It's the fastest moving market. And so, the path to becoming the truly dominant player on a global basis is going to have a stop off in the US pretty early in the journey. And that's to be encouraged. We want that to be something that is core to the aspiration and core to the execution, of Europe's best and brightest companies. But but that doesn't mean that they can't remain, anchored from and building from Europe. It's just it just means that the future state that we're working towards is not one where they uproot entirely and go and plonk themselves on the other side of the Atlantic and shift their HQ in that way, as Sarah was saying.
Yeah, I think this is one of the most important charts in the report, and there's so much going on in here. But I mean, the reason why I mentioned that the report is like a Bible for policymakers in this space, but the reason that policymakers care about tech and startups is because they create value and they create jobs. And at the end of the day, if those companies end up not being built here or not being funded here, then that value and those jobs don't materialize. So this is we see the potential here, but then we're kind of seeing what's left on the table as well. And maybe Yoram, because you've done some analysis of not only where capital comes from in terms of VCs, but also who the LPs are in those funds. And can you kind of explain the implications for pension funds and pension holders when we kind of if we were to go to one more layer of this chart as well?
Yeah, exactly. So of the European funds that are on this chart, their LPs often are predominantly actually from the US. So LPs are their investors, and pension funds don't. They represent all of us, like the savers, and European pension funds are notorious for basically not investing in venture capital at all. Like it's you guys have also run the numbers. It's negligible basically. Whereas in the US, it's like the big pension funds invest about 1, 2, sometimes 3%, and that underpins the whole industry. So it's like you're kind of there creating this virtuous cycle where you have basically the population, the savers who are reinvesting in their own economy and keeping that dynamism alive. Whereas, European pension funds are, for lots of different reasons, like very kind of risk averse. And there's a lot of structural reasons for that, but it's also to a large extent they actually do have. There's billions and billions that could be invested in venture capital today. But instead, it's mostly goes into short-term assets. To the extent that it does go into equities, it's often U.S. equities. And I saw, you often get pushback on that as well, where they say, "Oh, isn't that risky?" Well, we're talking about a tiny diversification. Currently, there's a huge concentration of owning Apple and Google and Facebook. Like how that's also not risk-free, So it is, It is definitely something that there's still a lot of education that has to happen.
It's I think we spend a lot of time actually going and trying to do that education. And to me, I think there's still 3 things that ultimately prevent this from moving at greater scale and faster. One is actually fees. So there's still a mindset to look at the cost and not the value for money. So there's a lot of work to be done to basically go and engage with the pension community to help basically look at it from a total return perspective and not just the baseline fees. So obviously venture managers do a lot of work for those fees. The second thing is, as Yoram said, is there's still structural regulatory constraints that ultimately mean that it just becomes either total restrictions that prevent capital being invested in this asset class full stop, or that just disincentivize it because of the way that that capital has to be accounted for, and also because of the perceived risk, as you say. And then the third piece, which is probably the least well understood, is simply we just don't have enough people in terms of capacity and capability working in those institutions that have invested in venture as an asset class. It's a pretty complex asset class to get your head around and to invest in. And if you don't have that expertise in-house, it's easier to sometimes just to say, no, we're not going to do it. And so actually one of the biggest needle movers could just be helping to build that class of people that have that expertise. Maybe we just have to go and poach some talent from the US and bring it over here.
Yeah. And I guess that has downstream effects also on the public side, that they're kind of not as up to speed on tech companies that could go public and like being kind of able to read how what their growth plan looks like.
Yeah, so we've spent so much time, over the years looking at basically capital needs in the private markets, but on the public market side, there's a huge amount of, of work to be done too, to basically build scale and sophistication and just absolute capital firepower behind European managers that fundamentally understand growth investing and tech investing. Like, we just have a much smaller pool of people here in Europe. Like, there are some amazing people investing in the public markets, from here in Europe, but you compare the depth and breadth versus the US, again, there's a lot of catching up to do there too.
No, I think this kind of shows you in a nutshell, like, how tiny the European public market is, and also how fragmented it is, right? Like, actually, if you look at effectively the NICE and the NASDAQ, they capture 99% of the total listed value. But yeah, we did a funny calculation of, what actually, if you had the same level of fragmentation in the US than you have in Europe, like, how would that look like? And it would mean that you would have 400 plus stock exchanges in the US. So you would have effectively 8 per US.
Yeah. So if you basically just look at like average market cap per exchange in Europe, and if you applied that to the US.
Yeah.
So per county you would have an exchange or something.
Yeah. I mean, I think as Sarah said, it's like in the US it's 99% of all value on 2 exchanges. Our tech companies are listed on 36 different exchanges. I mean, It's like, that just does not set you up for success, right? In terms of kind of where attention goes, where capital flows.
And just on the pension fund level as well, I think it's like our level of fragmentation is like, really high. And like in the UK, you have like hundreds of or thousands of pension funds.
Yeah, and this becomes such a big part of the issue, which is like, if you're simply subscale, you cannot, back to this point on not having the talent and the capacity, it's because you don't have the scale that allows you to invest to build the team. And so that's why a lot of the work that's happening, in I guess like country by country and across Europe is, okay, like what can be done to try and aggregate that so that you then do have, I guess like a resource base that can allow you to build, basically best-in-class talent and best-in-class kind of execution of these types of like alternative investment strategies.
I think one more point maybe on this chart as well is that there's often a call for more capital in Europe, and it might be that people think, well, why do we need that? Like, is that just investors who are trying to raise their next fund or something? But what we're showing as well is that actually there's a huge amount of potential and a massive pipeline of companies in Europe, so much so that overseas investors are coming to invest. And so there's a huge amount of quality. It's just that those companies that do get funded, all of that value then is captured elsewhere. So the opportunity is there, and then it's just not being taken by European investors.
Like, the benefit of US investors coming in is that they execute at an incredibly high level in terms of not just the types of investments they make, but how they work with companies and the impact that they can have to support founders in their scaling journey. And so that coming in is a good thing. It also just means that the bar gets set for how strong and how high quality we need to get our European investor base to go. So just like bringing more capital in and not seeing it go to manage or have the ability to essentially like compete with the elite from wherever they are in the world. It's like going to be a critical component to make sure that any extra capital that comes into the ecosystem gets to put to work in a way that's productive and is going to, be valuable to those companies, and secondly, generate the returns that obviously investors expect to see too.
And we've done analysis on the fact that there are a lot of great funds in Europe as well.
Yeah, I mean, we did this study on value add. I think maybe that's a good thing to look at. So if you look at like what's the graduation rate of startups in Europe versus the US, the biggest factor is actually the investor that you have, and in if you raise from a top tier investor in Europe, your graduation or your chance of success is as high as in the US, but the difference in Europe is a lot higher, whereas in the US it's a bit more stable between top tier and bottom quartile funds, and in terms of value add. And in Europe, it does really matter a lot whether you raise from, and I guess that speaks to what you just said. Yeah, there is still, I think especially across Europe, the VC market is maybe not always as competitive as it should be, and maybe that's actually one level of concern that I sometimes have, is that, okay, people have woken up to the idea that there needs to be more capital in the system, but then the way that it is injected feels maybe a bit too institutional and maybe too much government involvement. It does need to be competitive, and there's a huge difference between investors. Yeah, sometimes I guess government's trying to reinvent a little bit the wheel instead of just letting the funds that are already there compete for extra capital.
Yeah, I mean, I think like what we've seen in general is that like government has a really catalytic role to play, and has been foundational here in Europe in helping to build a layer of venture investors that have then gone on to prove, as your power law ranking has shown, that they can compete with the very best. And we've seen that time and time again. And I think like one of the things that we haven't necessarily said yet, and actually we haven't used the word flywheel probably throughout the whole of this conversation, which is a surprise because it normally comes up a lot. But the beauty of this entrepreneurial ecosystem is that things compound, right, over time, and whether it's like the quality of founders, whether it's the level of ambition, whether it's the density of talent, or it's simply the quality of capital that's being invested. Like these things are compounding over time, because like now that we have venture managers, and a growing pool of funds that are onto their third, fourth, fifth, sixth generation vehicles, like they've learned so much through those cycles of investment that they've gone through, and they just get better and stronger. Their networks get deeper. The way that they're able to add value, to your point, to their portfolio companies, continues to compound. And that's going to be something too, like back to this conversation that we were having earlier about, okay, like this is where we are today, but where do we want to get to, and what do things look like in 5 years, 10 years time? These are all going to be the things that, like to me, drive a lot of bullishness in my view on where the ecosystem will get to.
We've touched on fix the friction and on fund the future, but next is empower talent.
Yeah, so one thing that was clear when we were putting together the report is that there was a narrative that we kept hearing around, all the best founders leaving Europe to go and build from the US. In particular, with this new AI disruption and Silicon Valley having such a strong pull for companies and founders wanting to build in AI. And so we wanted to look at the facts. So we actually pulled this data together. What's really interesting is that effectively, about 80% of founders choose to start and to stay and build from Europe. So actually, it's very far from being like most founders that are successful want to leave. We also see the same trend for AI founders specifically, and actually for them, we've seen that trend improve as well in the recent year. We, of course, see that for seasoned European founders, there is a small dip there in terms of compared to the other two categories. So that one, is clearly a call to action that we want to make sure that we keep, the very best talent here, and the repeat founders that have experience, we would want them to also stay and build from Europe. So still, that number is very far from being most founders. So I think it was really important for us to address that point, because actually both from this number, but also from the survey where we ask founders effectively if they considered moving or staying in Europe, again, strong majority said they would want to stay and build from Europe, and it's part of their mission.
The interesting thing on this chart is, so when you look at the seasoned European founders and then you look at that chunk of European founders that are building in the US, and then you dig into who those founders are, actually what you see is a lot of the times it's European talent that left the ecosystem a long time ago. Like they left in the, like 15, 20 years ago to go and build career pathways over in the States, and then they simply stayed and have chosen to build from there. So it's not even that that big chunk there is being driven by people that have chosen to move in the last
recently,
2-3 years. Of course, there are those founders, and we always say one's too many. But yeah, we over the years, the Valley continues to be this magnetic pull for people with crazy ideas and crazy ambition, and so not surprisingly, that leaves a big legacy in terms of this European talent diaspora.
And you actually shared some data on just this the other day, which is looking at the share of unicorn founders that originate from Europe.
Yeah. So I shared that 24% of all unicorn founders are European. And versus something like 35 or something in the US. So, it's actually not the 10x or 4x difference. So in terms of entrepreneurial DNA, Europe is actually doing really well. And,
one of the other interesting charts that we're not showing here, but that we did ask, so part of the inputs to the report is also this big scale survey that we run every year. So, thousands of founders. And one of the questions that we asked was, to what extent is building from Europe something that you think about as being kind of core to your mission? Do you care about basically proving that you can build a company from Europe? And you see such a strong sense from founders that Mission Europe piece is something that they see as fundamental. About 50% say, building from Europe is kind of core to how I think about building this company. There's another third, roughly or so, who say, I'd like to build from Europe, and that would be my preference. But ultimately, I need to think about, what's going to set my company up for success. And therefore, if I believe that there's somewhere better for me to do that, then, I might consider moving. And then the rest is basically people that, are actively considering, moving. So I think that's been part of what has sort of been defining in the last 12 months, actually, when we talk about what's different, is this sense of we kind of feel aligned to Mission Europe. We want to be part of showing what Europe can do, and we want to be part of building a better future for Europe. That's why I think it's been so cool when you hear Anton, the Lovable founder, speak, right? It's he's so open about saying, I'm keeping the company here in Stockholm because I want to prove that we can build €1 trillion company. And so just that statement of, one, I'm going to prove that we can do it from here is great. The second thing is that I love now that we're openly talking about building €1 trillion companies, and that's not considered a crazy thing anymore. It's that is the ambition level. And this is I think we've had this conversation before in the past too, which is one of the things that, I've seen over the 11 years of doing this report is that the bar just always gets raised. It's when we started, we were probably, I think, still talking about €1 billion companies. Then we started talking about decacorns. Then you kind of had to...
I remember when we celebrated 100 billion.
Yeah, exactly.
Yeah.
And now it's we've built 100 billion companies, but that's not good enough. And it's great. Like, it's great that the bar just gets moved on us, because like that's also the global reality in which, you know, we're trying to compete and operate in.
I think that 24% of all unicorn founders being European is a nice counter narrative to maybe Europeans aren't ambitious enough, or they're too risk averse or something, because actually, yeah, it's almost on par with the US in terms of the share. So very cool. But we have one more pillar, which is actually nicely linked here, which is embracing risk. So the chart, do you want to talk us through the chart you've chosen for this?
All right, this is not the most sexy chart, I will concede, but we actually thought this was a good representation of the mindset of effectively the demand side, because what we need to build out here in Europe is more of that demand side. So one thing we spoke a lot about as well is like, okay, we're now raising the ambition from having billion plus companies to 100 billion plus to 1 trillion. What is going to get us to that is going to be a greater level of demand here in Europe as well. So of course, you know, we can go and we can win all the global markets, but we also need the market here in Europe to really rise up to the ambition level as well, and to embrace risk. And what is a great expression of that is today, you know, if you look at the share of public procurement in Europe, it's only 9%. And I think if you were to look at that as well across, you know, corporates, I think you guys have done some great research on that as well. You can see that across the board, there's just like a lack of engagement and a lack of support from basically those big institutions to work with the startup landscape. And oftentimes, you know, there are RFP going out, and it's going to kind of US software instead of supporting and actually running a process that is competitive and where a European can also have a fair chance to win. And if you look at that in context to other places in the world, you have like South Korea, which is leading with 25%, and the US with 20%. So effectively, we have like a 2x delta with some of these other places in the world. So I think that is a very actionable, measurable KPI that we can set on this piece. But obviously, it comes with just a broader appetite for working with technology and with startups, and also more generally just a education level and kind of having more collaboration between the two worlds.
Yeah, someone shared yesterday that the city of Amsterdam has as a target to hit 30% by 2030, right? So, I think, and those kind of things you're now starting to hear everywhere. And obviously, you want to build, you want to buy the best technology, but I don't know if you're like, not hate to pick on anyone, but if you're, don't want to piss anyone off, but if you're like married to Microsoft Office or like some kind of Oracle database, I don't know, like there are alternatives to these things nowadays, I think.
Yeah, but I guess also just to pick up Tom's point earlier, I think what also is an issue with the procurement process here is that there's a lot of red tape, there's a lot of friction. Right. As we mentioned, you know, if it takes months and months to basically win a contract, it's probably not worth it for companies that are trying to move fast. So I think that also is kind of the key issue. And again, having run the survey for a number of years now, when we ask specifically around that, it's really that. It's like it takes a long time. The process is not very clear. There's lots of red tape and bureaucracy. So I think that is also an area where we can fix the friction.
Yeah, I mean, like the way that it practically translates into reality for startups was captured really well by a Stripe chart. I don't know if you saw it. It's like from the end of last year, but they basically, Stripe looked at the scaling trajectory of, you know, startups in the US and startups in Europe, and startups selling in the US and startups selling into Europe. And you can just see, you know, what it means is that the scale is capped in Europe, and then the speed of trajectory is much slower because, you know, basically there are fewer customers willing to spend on innovative services, and their decision-making cycles are much more elongated, and so it's just much slower to scale. And so this, you know, again, this like brings it all back together of fixing the friction, embracing risk. Like really, we just need to get our 2 trillion, by the way, like procurement budgets into a place where per year. I mean, it's like the scale is insane, right? Like we have all these things in our hands. It's just like, how do we like knock down the hurdles that are getting in our way? Like we have that firepower. Because if you can truly unlock that, then it will just become much quicker and easier for companies to scale. And so that's why I think like our 4-pillar framework, that we've tried to simplify it as much as we can, but the important piece is like all of these things have to move together, because if you only fix one, like yes, that can move the needle, but what's truly going to move the needle like systemically is if you get positive progress and change on all of those things. And yeah, I think what's been interesting, like you said at the start, Orla, it's like nearly 100 days since we launched. It's felt pretty good, the momentum and pace of progress in those 100 days. Like even just like net new unicorn rate, it's like been on fire the last few weeks. We've seen, pretty like an uptick in the run rate level of investment. But then also even on the policy side, right? Like it's the Davos speech with EU Inc. and that feeling like it's, more concretely going to happen. Even things like the visa strategy being announced, like there's a lot of good things being cooked up now. And yeah, I think when we get to the end of the year, I'm hopeful that we'll be able to look back and go, actually, when we said that this was a crossroads moment for European tech, that we can say, actually, yeah, we chose the right path and we hit the accelerator down that pathway.
Nice. And on that procurement piece, there must be a certain amount of tech sovereignty question involved in that as well. And the US has always been great at buying from their own and supporting startups, and almost to the extent of creating a pathway for those startups to then sell into our governments. But do you think that's going to change things as well, this new focus on tech sovereignty?
So if you look at like US and China, like not to simplify it, but like China and the US unashamedly will say America first, and I can't remember the exact Chinese terminology, but they also have a national strategy that is essentially the same thing, which ultimately, it creates a narrative, but it shapes like decision making in terms of where capital flows, where how they think about talent, and obviously also things like procurement decisions. So I think if we are successful in kind of whether it's choose Europe or choose France, or like this is the thing again, we're going to have this fragmentation of different approaches. Yeah. If we can like instill that mindset, I mean, I do think that can start to move the needle. From my perspective, like I think there's a careful line to try and walk down between, enforcing procurement versus allowing people to make the right choices based on what's the best performing and best available option. But it's pretty standard practice in the US that tender processes would include extra points if you're an American supplier. And so I think there's ways to try and incentivize these things without imposing decisions on whether it's like public buyers or corporates.
Yeah, and I think as we said initially at the start too, there's a strong tailwind that comes from that, the desire to have more sovereignty around tech and around our infrastructure. And so I think that what we're seeing is effectively everyone is colliding into the same vision of the future, where Europe can define its future on its own terms. So I do think that is our version of tech sovereignty, which is we want to see, global strategic leaders coming out of Europe, being scaled from Europe, but servicing the world and kind of being, our effectively leverage in the current geopolitical landscape.
Yeah, I mean, to me, like sovereignty is really just how do you ensure that
preserve optionality?
Yeah, how do you have the ability to act independently, to make to have freedom of choice for yourself, and to ensure that you have basically the right capabilities to be able to make your preferred choices. And so from a technological sovereignty perspective, it just means building capabilities through the stack from energy, through compute, through chips, and we would ideally in a future state like to get to a place where you can have a full Euro stack, to use that term. But I think I think there's certain points of leverage that governments and policymakers have to drive that. But the single most powerful determinant of that, I think, is going to be what emerges from the private markets and from innovation, and basically creating the right set of conditions that mean that companies building those types of solutions can get to scale quickly and be globally competitive.
And you mentioned that it feels like there's been a lot of momentum since the report came out. If we were to look ahead to next year's slush, when you're kind of releasing the 12th edition, what would be disappointing to you if you don't see it materializing by then?
Yeah, I think it's what Tom already said, right? It's like we want to see this momentum convert into a plan that comes into action, right? And I do think we would be really disappointed if nothing has changed, if some of these policy are actually not coming to fruition because they're being blocked. So I think we want to continue to see that momentum translate into real progress that then obviously will trickle down and be felt across the ecosystem.
Yeah, I think one of the things that's powerful in driving momentum now is a sense of alignment amongst different stakeholders, whether it's like founders, investors, and policymakers in feeling like it's important that Europe wins in tech. And so I think if you see that consensus break down, that's going to be super disappointing. And I think the thing that would put that at risk is that especially that this kind of sense of alignment and trust between the entrepreneurial ecosystem on the one hand and policymakers on the others is a sense that they get it, they know what the problems are, and they're acting on bringing the solutions to market to make a change. And so if those things get stalled and delayed or they just don't happen, I think that's going to be the really disappointing thing, because I think you'll then just see that sense of kind of alignment and trust erode and dissipate. So
I think it was also interesting because when we published the report, we spoke about this exactly, and we were met with some skepticism about why is it different this time, what has changed, because we've seen this before where there's great plans but they don't really come to life. And we are, as Tom mentioned, it's been really positive to see how much momentum we've been able to get from the community on its own, and everyone, 18,000 signatures was it that EU Inc. got, so a widespread movement. And so I guess if this doesn't come to life at the end of the day, then that would be really disappointing, and I wouldn't want the skeptic to be right.
So the one number that we've also referenced a lot, and that comes from the State of European Tech report, is this 375 billion in growth capital need. Maybe you can talk a little bit about how you got to that number and how you think about that.
Yeah, for sure. So in a way, what we discovered when we were doing our research on the funding gap between Europe and the US is that we've effectively been bootstrapping European tech for the past decade. The way we break it down is quite simple. So we look on one side, as we discussed earlier, around the domestic share of capital. So if we were to normalize this, and if we were to have the same level of support in Europe to fund European companies that are scaling, so if we didn't have to go abroad to get that capital for those companies, that effectively sums up to about $75 billion. And then if we are actually looking at the funnel, which we discussed as well, which looks at the likelihood that a company is able to raise 15 million plus. So if we then look at that and we actually apply a similar conversion rate, that would effectively bring the gap up to 375 billion. So that's kind of how we get to that number. Now, what's really interesting is if we are to look 10 years ahead in the future, and if we're trying to think about what is the capital that we then need to sustain the ecosystem today. So if we don't think about the funding gap anymore, but if we just think about the future demand for capital, what you realize if you continue to apply the same case that we've had for the past 10 years, which effectively is just growing at a 10% compounded annual growth rate, you get to a $1 trillion need. So that's how much capital we'll need to fund the European tech ecosystem.
Over the next 10 years?
Over the next 10 years, if we correct for the level of capital that is invested by European investors. So if we match that 80% of domestic capital available for all the companies that are trying to scale from Europe, and if we then use a more, I would say, strategic case, which is we also want to provide, we also want to make sure that there's funding across the board in Europe to a level that is commensurate to GDP. Because what you realize then when you look at different regions in Europe is that they're all investing in tech at very different levels of GDP. So you expect countries like Spain, like Italy, if they were all to effectively pull their weight and commit the same level of funding that you would have in bigger economy like in the US, then you would need to get to 2 trillion of funding need. And that is to effectively fully support the companies that are here in Europe, also the ones that frankly just never get to raise venture capital because there's just not enough capital for them.
I guess if you compare that with the whole Draghi funding, which was about like 800 billion a year, so that's like also 8 trillion or even 10 trillion. And I think other amounts would come on top of that actually. So it's like 10% of our total investment need should go into frontier technology in a way.
Yeah. So I think that it's hard for people to get their head around because 1 trillion, 2 trillion, it sounds like this ginormous number, but actually, we're not the first people to try and model the investment gap and what it ultimately will take to get to competitive parity. Actually, like 1 or 2 trillion is a drop in the ocean.
Yeah.
The other stat that has really become fixated with, I think, in some ways, is there's a book that got published last year called Super Europe. It's by a professor called Professor Brice. And one of the things that he modeled was basically outflow of capital from Europe to the US. And the scale of, on an annual basis, of capital outflows from basically like all our institutions across all types of potential investments, from like fixed income into US public equities, US infrastructure, whatever it might be, it's 15 trillion.
Per
like that's per year. Like it's like that's the scale of the total flow of capital. Now, I think like to be fair, like some of those numbers you probably wouldn't measure on an annualized basis. It's it's capital that like kind of sits there,
right,
that's been put to work. So it's almost a bit more like in terms of total value of capital under management that's European owned but invested in the US. That's a ginormous sum, and so that begs the question of, okay, like you really only have to, like to this point of Europe first, you only have to redirect a small share of that to start to move the needle on some of the things that we've been talking about.
And then add to that the 2 trillion in procurement that you were
right,
mentioning
exactly,
earlier.
Which almost like entirely flows out of Europe, like that 2 trillion of spend.
Yeah.
Like it is, like you said, it's going to Microsoft Office 365 and Oracle database. Like that's where it's all flowing.
Yeah. Because people ask, where is the money going to come from? But we already spending it basically.
Yeah.
It's just redirecting it to our own future.
Yeah. And I think actually this is one of the things that I think Europe European politicians kind of woke up to a little bit too, which is like economic leverage. Like we do have like economic leverage when it comes to certain, conversations. Like a lot of the debate in Davos would have been, okay, like how did the Greenland debate change so quickly? It's because like if we really think about where we direct our spending power and our capital flows, then we have a bit more say than perhaps we've thought, especially only if we act together as a single voice.
Including the UK.
Yeah, including the UK. Very important.
Well, guys, thanks so much for coming to the office. We are already looking forward to the next edition, which I'm guessing we're going to be starting work on quite soon. Yeah. I'm sure you guys will take feedback from anyone who's listening, though, if they want certain charts they want to see next time.
100%.
Yeah, you know what? Like one of the questions that we put in job adverts is what's one thing that we didn't cover in the state of European tech and that we should. And it's always a great source of ideas and inspiration.
Nice. Cool. Well, yeah, thanks so much for joining us, guys. And we'll see you again soon.
Thanks for having us.
Nice.